This episode of Macro Mondays aired live at 12:30 p.m. on Monday the 18th of November. Tune in Mondays at 12:30 p.m. UK time to watch Macro Mondays live.
Hello and welcome to another Macro Mondays. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
And my name's Will Cunliffe, a research analyst here at Onyx Capital Group.
Today we'll be looking at more key market data, charts and risks. We'll be highlighting the rise in US yields. That's drawn the dollar much higher in the last week, and that's starting to have an impact on global asset prices.
We'll be looking at the mix of data coming out of China, but also the weakness across Europe. We'll then look at oil, which is continuing in a narrow range, awaiting a breakout.
So last week started with more of the Trump asset party, prices continuing to go higher. S&P and the NASDAQ made all-time highs. Bitcoin rose to $93,000. Investment grade credit spreads, the tightest they've been since 1998. High yield spreads, the tightest since 2007. But we are starting to see some cracks appear. The dollar strength and high yields has sent currencies a lot aggressively weaker. Gold's down 7.5% from the highs. And on Friday, we saw the NASDAQ fall aggressively, 2.25% on the day. The big danger to the markets is continually rising yields. The 10-year is now at 4.44%. And the market's pricing less than 50% chance that the Fed cut at the next meeting.
Yeah, I mean, clearly we're seeing very little demand for treasuries here. But how long can that last with yields this high? We might start seeing some more inflows or some support at the 4.5% yield.
Yeah, certainly as we've seen a few charts time, bonds at these levels are more attractive than S&P.
Yeah.
And the S&P historic valuations are extremely high now.
Yeah.
So you'd start to see some demand here, but we are seeing a big impact across other markets. The dollar strength is causing havoc in emerging markets. The Chinese yuan is now at 14-month lows against the dollar. The euro dollar is at 13-month lows. Indian rupee is the lowest it's ever been against the dollar. And what we've seen last week as well, Vietnam's central bank said they're willing to sell dollars to calm the dong depreciation. India's Nifty 50 index is off 10% from the peak, as we can see from the data there. And the Philippine stocks are off 14% from the peaks. So the dollar's really beginning to have an impact here. And personally, I'll show my age actually, I can look back and remember 1997, it was early in my career, but the Asia crisis, that was when emerging markets got hit really severely because of the strength of the dollar.
Yeah.
So the S&P last week, it closed above 6,000 early in the week, but we're seeing valuations at, say, stretch levels. Palantir price to sales ratio is 56 times and PE ratio is 300 times.
Yeah, and on Friday we started to see a bit of a reversal of this strength in equities, potentially people coming back to the fixed income markets. The NASDAQ was down 2.25%, and NASDAQ Biotech plunged 11.2% in its worst week since May 2020, partly due to the RFK nomination.
Yeah, absolutely. And if we look at the S&P 500, it's trading at 22 times earnings estimates. The average since 1990 is 15.9. So if right now it's to trade at 15.9 times, that would have the S&P around 4,200. So it's currently at 6,000, but while it's trending higher, you have to be long. But what we started to see on Friday is an aggressive sell-off, certainly in the NASDAQ. It will be interesting to see if this turns into a medium-term downtrend, because as we said earlier, with bonds giving the yields they have, that makes them look very attractive.
Yeah.
Also, we have record leverage in the equity markets. Retail have been adding, but meanwhile, we can see investors like Druckenmiller and others, professional investors, we can see are reducing their longs in the market. So retail are getting longer, smarter investors are unwinding.
Yeah. Well, I mean, Berkshire Hathaway have a record amount of cash at the moment, right? It's like over 20% cash pile. So that tells you something about equities.
Berkshire Hathaway, that's who I was just trying to remember, actually. I had a bit of a blank, so thanks for reminding me that way. But absolutely, they're unwinding their positions while retail's getting longer. That doesn't bode well.
Yeah.
Especially with valuations at these levels and bonds giving attractive returns.
For sure.
We look at the US data last week. CPI and PPI are both rising again. First time they've both been going up since September 2022. Again, it's not levels to concern us now, but it is trending the wrong way.
Yes, for sure. I mean, it's also looking at the core measure versus the headline measure as well. So core CPI was flat on the month of 3.3%. So that's the one that the Fed's really going to be paying attention to because it strips out all the volatile subcomponents, just gives you a good measure of the underlying inflation. So I think the market's broadly reacted to this as it's okay news. The Fed can continue as.
Jobless claims were strong. Retail sales were also strong. But if we look at the data, actually, we can see that while retail sales were strong, if we strip out inflation and we look at volumes instead of values, we see that volumes are falling. In fact, adjusted for inflation, these are down 5% from their peak. And that's a pretty serious move if you think the consumer's clearly hurting now.
Yeah, for sure.
Other data we had out last week, New York Fed, November, the Empire Manufacturing Index for the New York state, that jumped from minus 11.9 to 31.2, highest it's been since September 2021. That's really strong. On the flip side, though, the number of bankruptcies has risen at the fastest pace since the financial crisis, jumping 40% year on year, with Chapter 11 filings now, say, the highest in 13 years.
Yeah, and that's really quite striking because obviously corporate spreads are very, very narrow at the moment. So it's like, how is the market pricing this risk? Bankruptcies through the roof, but risk premium tiny.
Again, it smells to me like complacency.
Yeah.
And with that, the Fed's Powell was left less dovish last week, indicating the Fed are not in a hurry to cut rates. Fed's Logan said the US central bank most likely will need more interest rate cuts, but should proceed cautiously. The OIS we were discussing just before we came on air, the OIS about a month ago was talking about 50 basis points at the next meeting.
Yeah.
Now it's 10 or 11 basis points.
Yeah. And you go 12 months out, we've gone from 140 basis points to, less than 80. And so, the OIS curve is really, really driven down.
Again, that's probably another thing that's biting against the NASDAQ.
Yeah.
And equities have been going up on thoughts of Fed cuts. Now that's being unwound.
Completely.
We're going to have an interesting few weeks ahead. Another important point as well, of course, is we talk about what Trump's going to do, but he's not coming in for several months. So all these tariff discussions are going to be just discussions for a few months until we see what he actually does when he takes office.
For sure. And the tariff discussion is quite interesting as well, because when you start looking into it, you realize, 38% of US imports are from free trade agreements, which would obviously be exempt from tariffs in theory. And also the tariff is probably most likely a bargaining chip. So 60% tariffs on China, 10% tariffs on everyone else that's just the first offer. There's going to be a meet in the middle process. So realistically, how much of that tariff is going to be implemented, it's still to be seen.
Yep. And China can fight back as well.
Exactly.
Something like 100% of Europe's hard rare earth imports come from China. Yeah. It's over 90% of their soft rare earths come from China. I mean, that's Europe, but the US will be similar.
Yeah, exactly.
It's not going to be one way.
And then domestically within that, in the US, only 17% of consumer spending is from imported goods. So yeah, sure, you might have some pass through from intermediate goods being imported for final good manufacturing. But yeah, realistically, there's not that much consumer spending spent on directly imported goods. So from an inflation perspective, a lot of the estimates are very small for the impact on CPI. I saw JP Morgan come out with like 0.7% impact on CPI next year. And then other places have been around 1%. So yeah, still to be seen. Everyone's speculating at this point. You never really know with Trump. But
we got months of speculation.
Yeah,
that's the thing. It's
exactly.
not something like a headline date number that we have coming out next week.
Yeah.
It'd be interesting times. National Federation of Independent Businesses also say in uncertainty, their index is soaring, new all-time high in October. So businesses are certainly showing concern as well.
Yeah.
What we're seeing from the headlines of the S&P and the NASDAQ is certainly not being seen by the smaller companies.
Yep.
Also, we've spoken about this quite regularly, US housing, but US multifamily housing unit completions hit the highest level in 3 years. So supply of housing is coming online aggressively, the most aggressive in three decades. But mortgage rates are just getting close to 8%. That's going to hit demand. Classic demand and supply. There's only one way I can see housing going here.
Yeah, and mortgage applications have been declining week on week for I think 6 or 7 weeks now.
Yep.
So yeah, the demand for housing is not there. So you've got a big glut in supply that can only send the market one way.
At some point, it has to become unaffordable.
Yeah.
And again, the tipping point usually is when unemployment starts to go up, because then people are forced to sell. That's when they start hitting the bids.
Yeah, yeah.
And Bitcoin trading over $93,000. Interestingly, Dogecoin, that's had a big spike. Dogecoin's up 170% in the last 4 months. Obviously, it's been supported before by Elon Musk. Then last week, we had the headline that Donald Trump was going to, had decided to have Elon Musk as head of the Department of Government Efficiency. That's it. Acronym DOGE. And on that news, Dogecoin jumped 8%. In an instant. But money's flying back into cryptocurrencies.
Yep.
Where's the top here? Is there a top? Is it worth continuing investing? Is it going to the moon?
It's a tough call for me. I think with dollar strength at the moment and with treasuries where they are, I think crypto is a bit of a risky gamble for me. But
yeah, I think it smells a bit of irrational exuberance.
Yeah.
But again, I'm a big fan of distributed ledger technology. It is revolutionary.
Yeah.
But how would you value this? I think this seems a bit of a
completely agree.
Complacency.
Yeah.
Yep. And on to Chinese data, mixed data out of China. Retail sales were really strong, up 4.8% in October, expected just 3.8%. So that's an aggressive beat, but industrial production came out weaker than expected, up 5.3% year on year for October, estimated to come in at 5.6. So that was weak. And as we can see from the data here, Chinese house prices continue to slide in October, although at a slower pace of decline, but they are still going down. And this is where retail typically have over 70% of their investment is in property.
Yeah, I mean, historically, vast amounts of intergenerational wealth has been held in the property sector in China. And then obviously with the collapse of Evergrande and the property market slump that followed, that was a big hit to the Chinese consumer.
Yep. And you say wealth has been held there, it's been made there.
Yeah.
We had a couple of decades of just crazy house prices.
Yeah.
People are loaded up, they're leveraged, and now it's going down, and it's still going down.
Yeah.
And with that, deflation in China intensifies. PPI's fallen for a 25th consecutive month, down 2.9% year on year. Again, we've had the stimulus, haven't we? But
it's not really passing through yet. We had obviously the big wave of monetary stimulus which sent the CSI through the roof. But
that's fallen about 40 to 50% since, and now it's stabilised at that level.
Exactly. And then we also had a wave of fiscal stimulus as well, mainly targeting bank liquidity though. $10 trillion worth of special bonds announced to be issued, sorry. That's a huge injection, but it's not passing through, from what we can see at least. And that's really reflected in Chinese credit demand, which has continued to just deteriorate, really. Outstanding yuan loan growth slowed to 7.8% in October. This is the slowest pace of loan growth year on year on record, even as the PBOC is aggressively cutting. You know, they've been cutting rates since 2019, and the MLF is now down to 2% in September. But this isn't really boosting any credit.
This has to be a massive concern.
Yeah, I mean,
massive concern to PBOC.
For sure. I mean, you can do supply side intervention in credit markets through monetary policy easing all you want, but if there is no demand for credit, how effective is it going to be? How effective is your policy going to be when you have a consumer base average savings rate of 50% compared to the US, where it's more like 18%? That pass-through is going to be so much slower. The amount of stimulus needed is going to be so much bigger. Yeah, it's definitely something to be watching out for and concerned.
So you think China turns into another Japan of the 90s?
I think it's moving that way. I think it's definitely looking likely. I mean, the signs are already there. PPI can't get it out of deflation. CPI flatlining.
Asset prices falling.
Asset prices falling, and now credit demand drying up. Yeah.
And what can they do? Just more bazooka stimulus?
Yeah, I mean, I think the market has been really asking for consumer targeted fiscal spending. So a lot of it has been supporting the bad debt that was accruing in local governments, trying to offload that from off balance sheet hidden debt, it was termed, back onto the balance sheet. But you know, we saw at the third plenum China preaching about how they wanted a new fiscal strategy that would be sustainable and modern and not just driving GDP growth through big infrastructure investment projects as they had for the past couple of decades. So they're also being mindful about that pivot in that they want to modernise and integrate better.
But they need to get the consumer spending.
Yeah.
That's what they need to focus on.
Yeah.
Got to be a big concern. Meanwhile, actually, on the flip side, leveraged trades in China hit the highest level in 9 years. So people are not afraid to speculate. We saw lots of, we said earlier, lots of equity buying when the stimulus came out.
Yeah.
Does this say increased confidence or increased risks? I mean, we really need to see the CSI 300 actually start to trend higher from these levels.
Yeah, I mean, it's tricky because a lot of what drove the CSI 300 higher was direct stimulus from the PBOC, effectively issuing financial institutions with capital to invest directly in Chinese equities. Of course, when you get free money, you're going to go put it into Chinese equities if you're given the chance. You can't do that forever. So there's going to reach a point where, it's not an intrinsic value there.
Again, the clear risk is if equities start trending down, then again, more alarm bells start ringing.
Exactly.
On to oil. OPEC cuts global oil demand growth forecast for a fourth month. This is something we've been calling here for months, haven't we? We've been saying we see far lower demand than the market expects.
Exactly. I mean, China was obviously the big driver of that. We've seen consistent weakness in China really since 2020, whereas you go back a few months ago and OPEC was still forecasting 700 KBD worth of demand growth for this year, and it's just not going to happen.
Yeah, in Europe.
Yeah, and Europe
is so weak.
Completely.
It's just the US that's holding in. And if we look at the chart, we have the chart up here. Interesting, we can see we're back at the sort of 71, 70.5 support levels. Again, if that breaks, actually before we get there, the fact that we're getting a narrower and narrower range, it's in a triangle. Typically when the market breaks up or breaks down, it breaks aggressively. But what we keep saying is we're seeing weaker global demand. So when there's no news coming out, the oil price tends to drift lower. But when it spikes basically on headline risk, whether it be Middle East or Russia, Ukraine.
Completely.
Interestingly, last night, the news that Russia did the big bombing of Ukraine. Ukraine's been given the green light to to bomb in Russia,
Yeah.
you'd expect that to spike. And then Brent oil prices has barely budged this morning.
Yeah, barely moved. I wonder how sensitive the market is to Ukraine, Russia, geopolitical flare-ups. We'll be hitting the 1,000th day of Russian aggression towards direct aggression towards Ukraine.
That's incredible.
On Tuesday. So, yeah, it's still to be seen. But yeah, it could definitely lead to a pretty significant worsening of the conflict, I think.
Yep.
So,
and again, with the chart
escalation
as well, when you get the breakout, let's say it goes down, then what happens? The longs in the market then liquidate their positions. Their stops are triggered, so they sell. People that want to go short, they put fresh sell orders in, hence you get aggressive moves. Likewise, if it breaks upwards, but it keeps trending down to this level. You can see it was at 70.5. Now it's just below 70.
Yeah.
But if we get a close in the 60s, then you're going to see aggressive selling, and I think we see a down move.
Yeah, and I mean, thinking back to a few weeks ago, we kind of broke through 70 very briefly, and the market was positioned incredibly short at that point. So when you reach those extremities, you often see the market going the other way because
There's no more sellers
there's
left.
no more sellers left.
But now it's more neutral.
Yeah, there's breakout looks almost certain.
And that's a key technical. That's what technical analysts would look at. They ignore the fundamentals.
Yeah.
But we know from technical analysis where the stops would be, so we know where we get the fast move.
You have to look at both, really.
Yep. And if we look at an old chart, we had an old favourite, the correlation of Brent oil and the 10-year yield. You can see that's completely broken.
Yeah.
Is it broken forever, or is this temporary a tiff, if we put there? If oil goes down, then that has a disinflationary impact.
Yeah.
Not just for driving transportation, but it's used everything from paraxylene in water bottles to packaging, toothbrushes, everything. Naphtha, aviation fuel.
Yeah.
So you'd think if Brent goes down, you'd expect to see that have an impact on the 10-year yields and less worries, concerns about inflation.
Yeah, and I mean a lot of that, as we've spoken about on previous podcasts, a lot of that initial drive up in yields wasn't driven by inflation expectations, really. The break-evens were pretty flat, whilst real yields were really rallying. So that tells you it's a bit about, it's a lot to do with growth. But then recently we've seen the inflation expectation measures tick up again. So we're seeing the market pricing inflation again. That should mean that a fall in oil prices would lead to a revision of those inflation expectations and a convergence in the relationship.
Interesting times. Jose, the yields there's been a roller coaster this year. We started the year pricing 6 cuts.
Yeah.
Then it was taken out to nothing. Then it went to, I think, about 140 points of cuts a few weeks ago. And now the market's suddenly saying, well, maybe no cut at the next meeting.
Yeah, and you had people like JP Morgan calling for 200 basis points before year end, only a couple of months ago.
Yep.
So.
And you're looking at Europe. We had a month ago, we had a brief tick up in data, but now all of a sudden we're on the lows. The IFO Institute in Germany said industry's worst slump in orders since 2009. ZEW survey expectations in Germany came in at 7.4 from estimates of 13.2. Germany used to be the big economy in Europe.
Yeah.
And the demise in the last 12 months is, I don't remember any country falling so quickly.
I mean, it's really striking, especially ahead of a Trump government. I would have expected a lot of exports to be front loaded, and we'd start to see a lot of orders coming in as people try and front load their orders in the States, for example, because 20% of Europe's exports are going to the States.
Yep.
And we saw that in the Chinese export data, but that has not come through at all to the German new orders data.
And also the ZEW current situation, expected to come in at minus 85, came in at minus 91.4. And Bank of France now predicts zero growth for final months of the year.
Yeah, it seems like a pretty persistent issue across all of the euro area.
Yeah, that's been a dramatic downfall as well, because when they had the Olympics, the economy was booming, but as you'd expect, all that money coming in, tourism especially, but it's been a pretty swift collapse there as well.
Yes.
UK unemployment jumped, expected to come in at 4.1, jumped to 4.3%. That's bad news, but from an inflationary perspective, it's the worst case possible for Bank of England. The economy looks to be slightly weaker than expected, but wage growth came in higher than expected. You can see there from the data on the chart, you can see that's the pound against the dollar, the proud pound, and you can see a key trend line has been broken, but you can also see the last few weeks it's been one way, pound down, and we had it the previous chart, that was euro dollar down.
Yeah.
Currencies, it's all about dollar strength. And of course, it has such a big impact on emerging market economies because of commodities for good reason. All except palm oil are denominated in dollars. Also funding, so much international funding's done in dollars.
Yeah.
Dollars getting higher, it's getting more expensive. On to Japan. Flip side, Japan PPI there came in much higher than expected, estimated to come in at 2.9%, came in at 3.4%. Japanese yields are surging, 30-year yield, the highest it's been since 2010. The OIS is now pricing something like 47 basis points of hikes over the next year.
Yeah.
So actually, looking at the chart there as well, interesting, that's a chart, again, it's another favorite we have, dollar yen against the interest rate differentials. And you can see that the dollar has driven the yields much higher in the last few weeks. But again, what we're starting to see now, what we expect to see next year actually, is the market dollar yields start to fall, but Japan will still be pricing in hikes. So
yes, so more of that carry trade unwinding, I guess.
And we had a big move on Friday night, actually. We talked about the NASDAQ going down, but the yen had a really big move. I think it moved about 4 big figures against the pound.
Wow.
So that's nearly over 2%. That's a big move.
Yeah.
And talking from a trading perspective, from currencies, looking at trading currencies, I particularly like trading the yen crosses because the predominant mover of currencies is the interest rate differentials. Of course, many things move currencies, Brexit, political instability, and so on. But the main driver is interest rate differentials. And why that's so good with yen crosses, because yen rates are about 0.25%. Dollars are up near just below 5%. Yeah. So it has a bigger impact. If you were to trade currencies like Aussie Kiwi or Euro Sterling, those interest rates are much closer, so you get much less trend.
Yeah.
They're better for mean reverting trading than trend following.
Interesting, yeah.
And if we look at the OIS pricing for the next 12 months, Fed is just down at 71 basis points of cuts expected. That's had a big move. ECB hasn't moved nearly as much. The market's still expecting nearly 140 basis points of cuts there. New Zealand, again, the market's expecting aggressive cuts there. Bank of Japan hikes 46 basis points. Yeah. And we're seeing much more talk about when will they. Ueda made some comments this morning that were a bit more aggressive.
Yeah, definitely one to watch. I mean, they've been kind of all over the place, really, with their kind of forward guidance. The pausing and then the hiking and then the pausing. And then...
the yen graveyard. I've been there. I've been a victim of that. But what drives currencies? If you have two central banks moving interest rates in different directions, then that's prime for currency.
For sure.
So New Zealand yen, we haven't got that chart up, but that'd be an interesting one. That's certainly trending one way.
Interesting.
So the big risks in the weeks and months ahead, for me, I think higher yields is the biggest risk to the market. And with that, of course, a higher dollar.
Yeah.
Talk of tariffs, again, that's going to take months to play out. Even when Trump takes office, as you say, it's a bargaining chip. It's going to be lots of backwards and forwards. Remember the old discussions with China before when Trump was previously in office? Yeah. That took literally weeks.
Yeah.
Treasury Secretary nominations, that's coming under a lot of scrutiny.
Yeah.
Scott, we had it, Bessent is my favourite choice because he's well regarded in academia, but also he's got a good track record in the markets as well. So he can see it from both perspectives. So, but there's some other names out there. Kevin Walsh is one, Howard Lutnick's another, and Mark Rowan from one of the Feds.
I think so, yeah.
But Trump's had some, how would you say it, last week, some nominations that raised a few eyebrows. but he certainly puts his stamp onto things. Middle East and Russia, Ukraine tensions, of course, also a headline to keep an eye on. And European growth seems to be going one way at the moment.
Yeah. And also, I'd also keep an eye on the China situation, what stimulus might be coming out.
Absolutely.
There, because, they need to do something.
Yeah, and again, that's a tough one because that is a headline risk. It's a bit like trading oil. Stimulus, when it comes out, it's a big headline risk. It's a big market mover.
Yeah.
The others tend to be, certainly with the data, tends to be we know exactly when it's coming out. We know exactly when the Fed meetings are.
Yeah.
Headline risk is the hardest to trade.
Yeah, for sure.
So what's coming out in the week ahead? On Tuesday, we have US building permits and housing starts, not really seen as key data. Wednesday, UK inflation. Thursday, US existing home sales, jobless claims, and Philly Fed. Friday's a big day though. We have the PMIs in the US, both services and manufacturing. That'll give us a good indication of where the economy's going. I mean, manufacturing globally has been weak for several months, but service sector's been absolutely booming.
Yeah, I mean, we've seen a massive divergence in services and manufacturing PMIs. Fortunately for the US, their GDP is predominantly services driven.
Yeah, 3/4, I believe.
Yeah. If we'll probably see more of that strength there. Also in the inflation decompositions, a lot of the inflationary pressure is coming from services inflation, whereas your durable goods inflation and your energy is very, very low. But that'll definitely be an interesting one to keep an eye out for.
Excellent. Also, Eurozone services PMI and UK retail sales. So lots of trends in the markets, lots of interesting charts, lots of risks.
Yeah.
It's going to be an interesting week ahead. So thanks for joining me again, Will.
No, thank you very much for having me.
And have a good week. Thank you very much.